Hey everyone, on today's edition of The Final Bar, bit of a sell-off this morning. We're sort of following through from last weekend. It seems to be a Monday trend where we digest what happened over the weekend, sort of finish things going a little lower. So we're going to try to hit today's market from a couple different perspectives. We'll recap it from a big picture. We're going to think about some of the sector themes and also some of the individual names that are fluctuating. Look at our coronavirus portfolio, sort of see how those names are performing here. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every day after the close to digest the movements of the day, think about them from a technical perspective, try to connect the short-term fluctuations with the long-term trends. And, obviously we're digesting, we've got a fire hose of inputs, of macro themes, of stories, of events that we're trying to digest. And again, the goal with charts is to try to translate all of that into the visuals, right? Try to use the charts as a way to illuminate all of that stuff. Because remember, that stuff doesn't move the markets. It's people's interpretations, their reactions, their emotional engagement with the stories of the day that are actually causing stocks to fluctuate. And so charts give us a little bit of a window into that mindset of the average investor, of the collective psychology of all the investors. And we're going to try to break down those themes from a couple different angles today. We've got some guests coming up this week on this show and also with other specialists to help us try to make sense of the market environment here. We appreciate you coming to StockCharts TV to try to answer some of the questions on your mind. So today we actually premiered our Behind the Charts interview with David Auerbach. David's a real estate expert. Caught up with him at the Money Show. So check that out on our YouTube channel if you missed it. Tomorrow on Tuesday, we have Rob Slimer from Fundstrat. On Wednesday, the 25th, Pat Soresan from the Market Huddle podcast. I actually was on their podcast on Friday, went out Saturday morning. Had a lot of fun talking about sort of my background and process and going through the market environment. So worth seeing if you missed it. On Thursday, we have Matt Maley from Miller Tabak in Boston. And on the 25th, this Wednesday, make a note, we have a special event coming up called Navigating a Bear Market. Along with a number of my fellow StockCharts contributors, I'll be sharing sort of a couple charts that I'm thinking of in terms of how to process this bear market environment. So check that one out for sure. So, Monday, today we had plenty of volatility. And if you look at just the last 2 days on the S&P 500, certainly a choppy tape. And you can see looking at the intraday chart of the spiders, isn't quite updated into the close, but pretty close. You can see after we came down out of the open, sort of sold off to around 222 on the SPYs. Since then, it was sort of range bound, just kind of chopping around. And by the end of the day, didn't really go a ton different from the open, but this whole range is a new low. So this is a new intraday low, new closing low for this cycle for the S&P. And so basically what's happened is we've sort of digested the moves from the weekend and now sort of fluctuating at this new equilibrium level. We'll have to see how the news over the remaining, the course of the week, moves stocks going forward. Interesting to note the mid caps down 3.13%, so a little more than large caps. Small caps down a little less, though. Small caps down 150 basis points, so a little less. The NASDAQ 100 actually finished in the positive, and the NASDAQ index, the composite index, was toying with it. Kind of came down a little bit going into the close there, but overall essentially flat for the day. Let's look at a daily chart of the S&P. We're going to come back and talk about some of the sector and stock themes. So, this is the chart that I've been using for the S&P, my daily chart. And again, I can sort of tell what the market is doing by what I have to do with the time frame of the chart. I keep having to add time just to make sure I keep that 2018, that December 18 market low in the picture. So I keep adding another month to do that because, as you can see, we've now broken below there, and that 2350 level we've talked about for a while finally was violated on a closing basis on Friday. When we did the show on Friday, I remember talking about looking for follow-through, looking for some sort of indication that that was not just a one-day event and we were going to rally back higher. We had the lows from earlier in the week to think about. And so it was, do we get the follow through? I think today we answered that question with downside follow through. So again, with these divergences we've seen, I had a lot of questions on the bullish divergences. Is that positive? And again, what I would tell you is until we get some indication that a lower low is the last one of sorts, right? Quote unquote, some sort of capitulation low, suggesting that it's established. Until then, this is just a market going down. So this divergence will keep looking divergence-ish. That's not a word, but it'll keep looking like a divergence as long as we keep going lower and the momentum is not as negative. And so this divergence actually can keep going. It'll keep looking like this as the price keeps going lower. It's kind of how the math can work out on this. So I think it's very dangerous to be betting on a divergence until you get an established low. So at this point, I think the trend is certainly down. We'll have to look at the weekly charts to think about some further downside. And when I'm looking at it, the next real level to pay attention to sort of this 2030 to 2100 level. This is going back to 2015, 2016. We're back in that range pretty soon. That's the next real support. And after that, we're down to 1800, which is the low from the 2015 to 16 sort of cyclical bear market cycle in there. Let's look at some of the other themes. And again, the good news about Monday, what we've tried to do is hit the market from a couple different levels. We're going to have a segment shifting stocks. We're really getting into individual names. Also a segment on sectors where we can dig into those. So I just want to touch on today's movement. So consumer discretionary was flat. Communication services was the only positive of the 11 sector, really up 78 basis points. On the downside, energy, financials leading the way down, followed by real estate and utilities. So again, we have this interesting sector situation where it's not the traditional offense leading on up days and the traditional defense leading on down days. It's a mix of things. And I would say now more than ever, it's really important to look at the sector charts, the group charts, and don't make assumptions based on what should work based on the environment. Make sure you're looking what actually is working. We're going to come back to stocks in a few moments. I did want to just highlight some of the ETFs that were fluctuating. So Russia actually recovered the most today, followed by Germany, then Italy. And then the Chinese ETFs actually finished a little bit positive there. On the downside, India down significantly, followed by Brazil, followed by Mexico. So again, we're going to have a lot of really sudden movements, I would expect, with a lot of these ETFs based on the news coming out of some of those countries. And when things look a little dire, it looks like with India, you're getting some changes, so, social changes based on the coronavirus. You're going to find markets that move. And again, this is all about making some assumptions, some expectations about where you are going to have, where these markets are going to go and how the economies are going to have to digest all the things that are happening here. In terms of groups, actually pretty interesting to note, toys recovering. I can imagine the Keller household loading up on toys for my two children that are stuck in the house for the most part, probably helping to bump this group up just a little bit. But as you can see, this group actually up almost 9% today, followed by recreational services, home improvement retailers. Some of the consumer discretionary groups up pretty big. You look at the chart of the home improvement retailers, I think this is what's so dangerous here to wrap up this segment. This is one of the top 10 groups today, up 5.5%. You would feel like that chart would be going up and to the right. It's actually still within last week's range because the volatility swings are so big. So again, if you've not sort of reprogrammed your brain for some of these percent swings, you have to be a little careful about seeing a big percent move and thinking, all right, this is now going well or this is going poorly. Look at the chart to see what it's actually doing relative to that range. So home improvement retailers, nice move today. It didn't go down when the S&P went down. That is totally valid. So on a relative basis, you're certainly going to get that spike. But on a price basis, right, still struggling, still sort of trying to get out of that equilibrium level, that range that we set last week. So be a little careful about some of those groups coming out there. Another one I just wanted to highlight very quickly was airlines, right? So airlines is one of the top groups today, top 5 groups. And again, it's one of the top 5 groups because it was up 4%, but still, again, very depressed relative to its previous cycles, still in a pattern of lower highs and lower lows. Remember that when you're if you start getting excited about an industry like that. That's our market recap for today. And boy, it's tough to not be a little bit depressing, noting how things are going down. But I think, again, one of the great benefits of charts is trying to put a frame of reference, trying to understand how today's movements fit into the big picture now more than ever. It's a really important part of your process, or it should be. Our next segment, shifting stocks. What we like to do with some regularity is look at individual names, what sort of group and name themes that we can see fluctuating. So I just want to hit on a couple things looking at this. As I've mentioned, I think a number of times every weekend, I like to go through the entire S&P 500 bottom up, just looking at the individual charts. It's an exercise I've done for years. And what it does is it helps me just make sure that I'm looking at every one of those charts at least once a week and getting a sense of some of the themes that come out. And again, you get a lot of sense of these themes by looking at things like the sector RRG and some other tools, but breadth, for example. But again, looking at the individual charts is where you really start to see what sectors and what groups are doing better than others. So, a couple of themes that kind of came out of that work that I wanted to share with you. Number one, if you look at the stocks at the top of the scooter report. So this is our StockCharts technical rankings. This is the top 10 stocks here that I'm showing on my left. And on your dashboard, you can add these objects and customize them here at the top. So I'm looking at the top 10. You'll notice it's almost entirely what I would call sort of that coronavirus bucket, right? There's this group of stocks, and it's a mishmash of things. It's consumer staples, things like, Clorox and General Mills, people making oatmeal and cleaning supplies type of stuff. It's things like Amazon, where they're going to have a lot more orders than normal. And again, stock like Amazon has been doing well, but this is certainly helping where they're needing to add delivery capabilities to keep up with everybody. It's biotech, so things like Gilead, Regeneron, other ones that have potential to provide the medical horsepower to address all the challenges that we're facing. There's grocery stores, something like Kroger. There's things like Citrix and Zoom, which are telecommuting names. So it's kind of an interesting bucket. I was talking with Grayson Rose at StockCharts here earlier today, talking about a coronavirus chart list. I'll have that on my list to try and put together here very soon, which I'd be happy to share with a lot of you. But this group right here isn't far off from what the final list might look like. A lot of the names that I just mentioned are represented in the top 10 to 20 scooter stocks. So again, this is a percentile ranking. So at the top of the list doesn't necessarily mean it's the best chart ever. It just means that it's better than all the other charts. So the top ranked stock right now is Regeneron. And again, in an average market, if you looked at this chart, you would think this isn't bad, right? It's actually pretty good. It's in an uptrend. It's pulled back. So you sort of pulled back to trend line support. If I connect the lows from February and mid-March, sort of lining up there, we're kind of bouncing off there. We're above an increasing moving averages. That's pretty good. But again, within the context of so many stocks struggling, look at how strong the relative strength has been just in the last 6 weeks, right? This is coming out of the low in February, broke to new highs the second week in February and just maintained that. So charts that look like this are very rare and very attractive on a relative basis. So again, I encourage you to look at some of the stocks in the top of the list there. Netflix is another one, again, pulled back pretty significantly along with everything, but has rallied very, very well. And you could only, you could assume that, a lot of people are going to be hitting the Netflix very, very hard if they haven't been already. You can see that the stock is doing pretty well on speculation that this is a name that's going to thrive in this environment where people are stuck at home and looking for things to do. So up 8% today, over 8%. And again, not making new highs, not the best chart ever. But again, within the context of what's happening, it's almost a cup and handle like pattern here, right? If you take the July last year high, you take the peak from last month, we're sort of nearing that upper end of there. So a break above 390 on a closing basis would be dramatically positive for a stock like Netflix. And again, imagine with what's happening here. With Citrix, we'll look at Citrix and also look at Zoom. This has been a choppier name. You look at the volatility up until mid-February with the volatility afterward, just in terms of the average true range, in terms of the normal daily fluctuation of the stock, you can see how much more volatile it has become along with everything else. But again, testing an increasing 50-day moving average from above in a normal environment would be pretty good. In this environment, it's almost magically positive. And you can see, again, the relative strength has done pretty well. And a sister name to this would be Zoom, ticker ZM. And again, both of these doing pretty well. Zoom has actually just accelerated. This is an IPO name, right? So it's coming out of a limited price history, but you can see this big base that came from last June to where we're at now. Extremely overbought. And again, we haven't seen a lot of these recently because so many things are down within their previous range, but extremely overbought means it's up a lot It should pull back here. That would be normally expected. And then you'd expect at least one leg higher. Now, this has gone vertical on a relative basis. That's just because everything else has been so challenged. It's up another 20% today. So some of the name like that feels very extended. It's going to have to pull back at some point, but based on all the news learning, this could go vertical a lot more than that. So again, long term could be a compelling option there. I did want to just finish up this segment on shifting stocks, just thinking about some of the other movements that we're seeing. So if you look at stocks that are up, a lot of the stocks on the biggest gainers list right now are coming from a relatively muted place. And I'm just sort of looking at the little preview chart. CDW maybe is a great example of that. You know, it's one of the biggest gainers today. It's up 7.6%. But again, stocks that are able to gain on days like this, when the market overall is doing poorly, is going to stack up pretty well to its peers. And I think that's what you need to reevaluate, right? We are programmed to be finding the best of the best charts. Now it's more of the best of the worst. And stocks that are holding up or not going down a lot are actually pretty good on a relative basis. So pay extra attention to that relative strength line, which is going to tell you the story there on a relative basis. Interesting to see an airline here on the top 10 gainers list. The airline group, again, one of the top groups today, still coming out of very weak areas. That obviously is speculation about bailouts and how they're going to be able to survive all of this, but interesting to see. You know, CME had been one of the strongest names here for a while. Really has struggled, really has fallen off, and as you can see on a relative basis, came up a little bit last week, but back down again today, pretty big, down 12%. So that's a group that had actually been a rare shining spot within financials that has been struggling a little bit. We don't have time to get through some of the rest of these, but boy, I love looking at some of these individual charts. Again, and you know, just the other wrap up, just to get in to preview our sector setups. Out of all the sectors, out of all the groups, something like technology still holding up on a relative basis is pretty impressive. We need to take a quick commercial break. We're going to be back with a deeper look at some of the sector themes to pay attention to. So we'll see you back in a minute. Hey everyone, welcome back to the show. I'm Dave Keller. I'm your host here at StockCharts.com. Want to appreciate all of you for sending in lots of good questions and feedback. And again, an environment like this, if it does nothing else, it's going to bring questions to the forefront. And as I've reminded you, we're here to help you get through this process as best as we can. So just shoot your questions right over to us. The final bar at StockCharts.com is the best way to get questions over our way. We'll have a mailbag segment probably tomorrow or Wednesday. So we'd love to answer one of your questions. So just shoot them to us via email. We'll gather all of those and answer as many as we can in the show later this week. Our next segment is called Sector Setups, and we like to do with some regularity is look at the 11 S&P sectors, start to see what sort of themes come out. And as I alluded to before the break, when I was doing preparing for shifting stocks, when I was looking at all the individual stock charts, you know, some of the things that come to mind, I always do it in sector order. So I start with communication services, then the consumer sectors, and then I sort of go down the list alphabetically. And what's happened for a while now is when you get to technology, things just look better. And in the bull market phase going into mid-February, it was sort of the best of the really good charts, right? The average chart looked pretty good, but tech looked even stronger. Now what's happened as things have rolled over, you have a similar situation in that the markets are actually doing a lot more challenged environment. The average stock is actually selling off aggressively. But if you look at the sectors, just to jump forward to the chart of the XLK, you know what I noticed on a lot of the technology charts, the price had come down, but look at the relative strength. And the chart of the XLK sort of tells a story there. This has been good relative performance in the bull phase, but also in the bear phase. And that is huge. That's why I tend to think of something like technology here as what a sort of a core position. This is the kind of thing that I would be pretty happy having that be a big part of a portfolio, and then be looking at other opportunistic positions around that. But even on a day like today, when it's down a little bit, it's down a little bit when the market's down a lot more. And so you can see the relative strength making new highs again for the last couple of years. So it just continues to impress. So with the tech names, again, on a price basis, not the best, but on a relative basis, that's where you're really getting some benefit. So let's look a little deeper at the relative themes. We're going to look at some of the performance characteristics of these sectors, and then go through a couple more of the individual charts here to round out the segment. So when I look at the weekly RRG, and again, if you're not familiar with this discipline, with this process, Julius de Kempener, one of our other contributors, created this and has a show, Sector Spotlight, which does a really good job. He articulates how to use this very, very well. So check out his shows on our YouTube channel. But what I do is I like to look at the weekly view. I do this every morning, but I really focus on it as part of my weekly process on Fridays. And what I like to see here is the fact that technology just continues to go, in an easterly direction. Northeast is ideal, but if it keeps going to the right, that just means it keeps outperforming by more and more. The relative strength is improving. It's just strong. It is long and strong to the right. So furthest to the right is strongest. Tech has been there and remains there. And that's why I think it's still, that's the leadership. That's the juice right now. Now, other sectors that are actually looking pretty interesting. Healthcare, which has come out of that weakening quadrant, has sort of pivoted. A lot of those stocks had been starting to pull back, but with the coronavirus challenges, things like biotech are actually improving it to a great deal. And you saw that a couple of the top 10 names in our scooter rankings were biotech stocks, things like Regeneron. So XLV has actually done pretty well here, followed by consumer staples. Those are probably the three strongest charts. The next couple, sort of the honorable mention, would be communication services, and then utilities. Utilities actually took a bit of a downturn, has been underperforming at a time when other sectors have been doing well. Real estate, you're seeing the same thing, starting to turn down a little bit. That could be just a short-term thing, but I think it's really interesting to see that some of these yield plays are actually struggling a little bit. Things like consumer staples actually emerging in a little better case. The ones to avoid are the ones down here in the lagging quadrant, especially those heading southwest. So from this approach, in my opinion, financials, industrials, and especially energy is telling you avoid at all costs. There's no technical reason based on the relative performance to want to consider those until you see some sort of improvement. Now, another way I like to look at the sectors is using the perf chart system. If you go up to, if you're not familiar with this, if you click Sharp Charts at the top of your log and switch it to perf chart, you can look at these great just performance comparative charts. It's a different way of sort of laying out some of the relative strength. It gives you some easy tools to sort of compare performance. I have this starting year to date, and I did that by right-clicking down here on the date range, and you can do some of the common buckets of time that you might want to review. So I'm looking year to date here. I'm looking at the 11 S&P sectors and then the S&P at the top. So on a price basis, this is energy down here. It might be a little difficult to see, but energy is this one at the bottom in purple. If I put the mouse on it, you might be able to see a little pop-up that says it. But that has certainly been, the worst of the 11 by any stretch, and that continues to be the case. You can see how everything's been struggling, right? So down 20 to 55%. If I click on the S&P, though, I can now see the relative strength of the performance year to date. You can see it's a little more spread around. About half of the sectors have outperformed. And if we look at it here, we can see some of the themes a little better. So this is year to date relative performance, and you can see that only 5 of them are in the positive. Communication services up 3.5%. Consumer staples, actually the number 1 sector now year to date, up 8.5% relative. Healthcare up 6%, tech up 6.4%. Utilities still up, even though it struggled in the short term, up 2.5%. The rest have all underperformed the S&P year to date. So 1, 2, 3 is consumer staples, technology, then healthcare. That's why they're in that upper right quadrant in the RRG work. What you can also do is look at them relative to major peaks. And I'm going back to mid-February. This was the market peak. So since the market has sold off on a relative basis, consumer staples, again, number 1, up 10% relative. Healthcare up 8% relative. Communication services is next, up 1.8%, followed by tech, up 1.5%. The rest are flat to down over that period. Utilities is sort of a market performer over that period. So if you start at the market top and go from there, you can see it's just a couple of sectors that have really given you outsized relative returns. It's consumer staples and it's healthcare. And this sort of lines up with that sort of coronavirus bucket that we were talking about, a watch list of names that should be doing well given the situation that we're in, and the relative strength from the market peak sort of mirrors that. After that, you have some sectors that have been doing well. And again, tech just continues to outperform. That's why, 1.5% in the last month is great, because it's compounded after a bunch of other good relative performance. So it's still in the positive. I thought it was worth noting in the last month, the relative strength has really come from some of those places like staples and healthcare. Let's look at some of the individual charts here really quick, just to round out the segment. I mentioned technology earlier, and again, look at the longer term trend in relative strength that continues to just really impress. Let's look at healthcare next. And obviously, healthcare, you have some of the sectors or some of the groups that we mentioned earlier today, things like biotech. What has concerned me about the XLV, you had this nice rally. It's pulled back in the relative strength just in the last week or so, gone to new lows, breaking down through trend line support was tough, and now breaking down through the market low from 2018. Boy, I was really looking to see if this would be able to hold it. Today, it's actually following through very much to the downside. So as an entire sector, pulling back pretty big in the last week or so, right? It's accelerated to the downside. So I think it's worth watching that for sure. Consumer staples was the third one that's done the best. Again, it's pulled back on a relative basis, but overall still doing pretty well. This sector actually is still holding its December 2018 low. So it's interesting to note, if you think about it, one other way to think about these sectors, just to wrap up the segment, is we can't see the history right here. I might tee this up for tomorrow, but if you look at where they're all at relative to that December 18 low, that might be an interesting way of just sort of looking at which sectors are able to hold up versus others, and where some of the opportunities may or may not be emerging. So that's our sector setup for today. And again, using the RRG, using the perf charts, and using the candle glance, looking at some of the individual charts, I think you get a pretty good picture of where some of the strength has been. And again, it's been in places like staples, healthcare, and technology. We need to wrap up our show, folks. Boy, half an hour goes by so quickly. And if you love charts, hopefully this goes by quickly for you too. I enjoyed doing the show, and I hope you're enjoying it as well. We're going to go to the 3 and 3. So 3 charts in 3 minutes. And if these aren't on your radar yet, I hope they are from here on out. So chart number 1 is the S&P cap tier. So we have large caps in black. In red, we have mid caps. In green, we have small caps. In purple, we have micro caps. That's sort of the order that things have played out here recently. What I thought was interesting to note is if you start at the market low, December 2018, you can see that the other cap tiers are down 21 to 23% over that period, over that 13, 14-month period. The S&P had been the only one of the 4 that was still in the positive for that period. It has now just dipped down in the last day or two into the negative. So now down 2.5% below its December 18 low. So while that seems like a significant milestone that we've finally gotten below there, I think this tells you that the signals had been there, right? The illustration, the weakening breadth, the fact that the other cap tiers broke down a couple weeks ago through their December 18 low shows you that there's been weakness all around. The large mega cap trade is sort of the last thing to roll over on a price basis. Chart number 2 for the 3 and 3 is looking at breadth, and I'm looking at a little longer term. We've looked at this chart a lot recently because I think for me, my sort of basic thesis, my base case on the markets is that this move that we're in is the beginning. It is not the end. It is not a V bottom sort of an experience. I think this has a lot more in terms of price and time. And one of the ways that I think I'm showing that is when you look at breadth. So only 3% of the S&P remains above its 200-day moving average. Only 1%, only a handful of stocks in the S&P 500 remaining above their 200 or their 50-day moving average. So pretty much everything has broken down at this point. If you look back, the last time we've been this low is back here at the 2008 low. And it didn't start being this low at the market bottom. It started being this low about 6 months ahead of time in October of 08, which was that initial first big push down, that first initial sell-off pushed the breadth this low. I think that's where I think we're sort of in the first leg. I don't think we're at the last leg of this experience. I think we have more in price, more in time. And I think that's how the breadth picture potentially is going to play out for a little bit longer. Things can stay muted for a lot longer than you'd want them to. The final chart is a chart of gold. We didn't talk about other assets. Last week, we talked a lot about commodities, fixed income. We'll certainly get back to those themes today. But I did want to point out, with gold, it sort of bounced off support from last fall, right? So November, you hit the low, you tested it again at the end of November. This was before it broke to new highs going into the beginning of the year, went vertical almost, broke to new highs in March, came back down to test that same support level. So even though it broke below the 200-day, it has now found price support, and the GLD has rallied right back to the upside. And those are our 3 charts, the 3 and 3 for today. I want to thank you all so much for joining us on the show today. Thanks for sticking with us. as we figure out how to keep Stock Charts TV running for you as best as we can. And overall, we're bringing some fantastic content for you to help you make sense of it. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.